Good morning, everybody. Welcome back to Schwab Coaching for the Monday edition of Trader Talk in today's market. I am your host, Kevin Horner. It is a crisp morning here in Denver, Colorado, but nonetheless, we are here to get down to business, and I am pleased to be joined by my friend and Schwab's regional investment strategist, Jeffrey Abalos. Good morning, Jeff. How are things in your neck of the woods today, sir?
They are looking beautiful. I'm in Phoenix, Arizona today. Shout out to all those in Arizona enjoying the beautiful weather. It's not as crisp as Denver, this I know, but very happy to be here with you today, my friend.
Yeah, probably not as crisp as we get here in the Mile High City, but nonetheless, a good start. We've got a little bit of a green open as we kick things off here this morning. If you'd be kind enough to say hi to our friend Connie Hill in chat as well. Connie's going to keep an eye on things for us there. You can also, if you're not already doing so, take a moment and follow Connie and me on X. Connie is available, Connie Hill CS, and I am Kevin Horner CS there. Try to post for you throughout the week and give you some intriguing charts or maybe some data that you might not be aware of there on X. It's a good way to get with us outside of the shows we teach here. So if you're looking for ways to get us a note, ask a question, etc., X can work very, very well for you. Let's also get into some disclosures so that we can start talking about the stuff y'all are here for, of course. Remember that our discussion is exclusively informational and educational. We do not make recommendations here nor endorsements for a particular strategy or approach to trading the market. We do, however, talk technical analysis quite a bit. Remember to consider technical analysis as a complementary viewpoint to your fundamental research. We think it can be a piece of the puzzle in your decision making. We encourage you to consider it as such, but we discourage you from using technical analysis as the only means of your decision making. So again, think of your decisioning to buy and sell in the marketplace as being multi-layered, right? We like to have a few different data points when basing those decisions. Now, if you're new here, this is the agenda we follow. We are here Mondays, Wednesdays, Thursday, and Friday for Trader Talk at Market Open. And we do a top-down approach. We start broadly looking at the major indices. We work our way through some of the important industry groups and then into sectors as well, trying to get a handle on where traders may be positioning for opportunity any day and week of our period. So with that, we're going to start with a look, as we always do, the S&P 500. Jeff, we had a good start on Friday of last week, and really a weak start to the week last week, but it was one of those scenarios where we start terribly and rally for the week. In fact, if you look at what's gone on here, that's kind of what we've done the last two. Weak open on Monday, good finish. Weak open on Monday, better finish. But Jeff, we've not gotten outside of this little downtrend line that seems to be kind of hanging over our noggins here, doesn't it?
Yeah, that's right. And remember, to all the viewers out there, when you're doing technical analysis, this is just the study of mass psychology through the use of prices. So what's happening? Every time we're bumping our head, it's generally because of a new tariff concern. So as we're finding more tariffs in the news, you're probably going to see a lot of people worried about that bullish caricature of the market. So as I'm looking at what we're seeing here, Kevin, the thing that's starting to concern, I think, a lot of market technicians out there is that we're now bumping our head at lower highs. That's generally not what you want to see. If you're continuing a bullish movement, you're going to see bumping your head at higher highs on an upward trajectory. So what ultimately happens, of course, none of us know what's going to go on there. But notice here, as we're coming into Wednesday and Thursday, I believe is when Fed Chair Powell is going to be speaking, we're kind of forming this wedge pattern, aren't we? We've got a little bit of a wedge happening here, and that testimony may be what decides, do we break up and continue going north, or do we break south and start moving below these moving averages? And I think that's what's going to be on the minds of a lot of traders coming into the week, Kevin.
Yeah, I think you're probably right, Jeff. I mean, it's fair to suggest that we're always looking for more detail, more information, and hearing some inflationary data this week will certainly give us more to work with and aid us in deciding whether or not traders are willing to add more risk or reduce their risk. In fact, let's talk about that real briefly, Jeff, because I know we probably have some viewers in here who may not be as familiar with technical analysis, but I think one of the things we can maybe fall back on in a very general sense is just the way that a trader might incorporate the purple and orange lines that you see on my chart here right beneath price action. So the orange line, as a reminder, is our 20-day simple moving average. The purple line is our 50-day simple moving average. As an example of how a trader may manage their current investment dollars relative to what the S&P is doing, if we were below those two major moving averages once more on a closing basis, Jeff, some traders would use that as an indication of weakness in two differing time frames, and further would start to reduce position size, generate or build cash, take a little bit of risk off the table. Is that a scenario that you can foresee here from traders you work with, speak with, et cetera, that, when you break down below major moving levels like those, the average of the 20 days, average of the 50 days, that can be a reason to tighten the purse strings a little bit for some traders?
Yeah, certainly. Now, you got to be careful out there, too, because you can get some head fakes as we saw coming into the year. You notice we went below the 20 and the 50, held beneath there for, God, what, 9, 10 days or so, and then ultimately came back up above that. Now, it doesn't mean we came roaring back up and things are looking great, but I do like what you're calling out, Kevin, which is if you're going to utilize a plan, make sure you're sticking to it. If your plan says, if I get some closes below these 20s and these 50s, then I'm going to start reducing my position size. You got to stick with your plan. If your plan says, as I go above the 20s and the 50s, I'm going to start increasing my position size, you got to stick to your plan. Now, recently, what's happened? Your plan has been a little bit shaky. It's moving in and then moving out and then moving back in. So you got to be really careful about that. But I do love that call out, Kevin, that whatever it is you're doing as a trader out there, make sure it's something you can put down on a piece of paper, show to somebody else and say, hey, this is what I'm going to hold myself to. Keep me current.
Yeah, I think that's ultimately what I was getting at, Jeff, is the idea of course, giving yourself the framework to make some decisions on the fly and kind of quickly. It's difficult to make those decisions in the moment if it's not something you've thought about. So I don't know if you've tried it, everybody, but if you're just watching these positions, watching your profit and loss scenario, and then you're thinking, all right, what could happen next? In my case, at least, I feel like I'm swimming with thoughts. I can't keep them contained and layered the way that I normally could if I had just given myself some steps. And if I'm making those decisions when I'm swimming like that, when thoughts are coming from all different directions, that becomes much more difficult to make a cogent decision. And that's what I'm trying to aid myself in doing by giving myself some of those steps in advance. Here's what I'm going to do if this occurs. Here's what I'm going to do if this occurs. It just reduces the angst of making a decision in the moment, I have found. So maybe give some consideration. If you find yourself feeling a little angsty like that, having those ideas on the table can help you out quite a bit. All right, so there we go, Jeff. We haven't broken directionally one way or the other. If we hold the 20 and the 50, we'll be fine from the S&P standpoint. Obviously, breaking that white downtrend line from the last 2 weeks, 3 weeks here would be great. We'd love to get that into the upside. Now, let's see how the NASDAQ is reacting here today. NASDAQ 100 performing a bit better. We're up better than 0.75% here. But really, Jeff, we've just pushed ourselves back into a zone of potential resistance. We've been beaten back at this 21.7 ledge a couple of different times in the last few weeks here.
Yeah. And what gives you hope as a trader is you look at that break above and you go, wait a second, we got up to about 22,250 and then we pulled back down. Yes, we did. But I think, Kevin, you're probably more right than what we would see on the chart there. And that is that level you have there is pretty prescribed. I think that's what a lot of traders are going to be looking at as we move in, not just through the rest of the week, but maybe even through the rest of the month of February, because you're noticing a sideways trend is starting to form. No longer is it that bull movement that we saw on the S&P 500 and on the NASDAQ. It's now, over the last few months, turned into a sideways trend. So a lot of traders out there might be sitting around saying, are we going to go higher or are we going to go lower? This could be a really good potential for those of you who are trading in a mean reversion strategy. And if you need more information on that, check that Schwab coaching link. They've got some information in there. But I think a really good call out on your part there, Kevin.
Thanks, man. Looking at what's going on here, I think we can see that there's that importance of this, right? This is a gap level as well. It's one of the things that we cover quite a bit in this class. We talk a lot about the importance of that gaps can provide in terms of resistance and or support, and the gap ledge is commonly an area that is strengthened beyond standard support or standard resistance. So the fact that we continue to struggle but not be able to hold this 21.7 level, I think stands out, particularly that candle we got on Friday, right? We tried to break through it. We had actually traded above the high from Thursday, and it did not maintain. Not only did it not maintain, Jeff, it gave us a fully bearish engulfing candle. Does that give you any pause for the thought process about the ability to break higher? It's a good start to the day. We're up better than 0.75%, but is that keeping you a little timid here, so to speak?
I think it would. And that's what I was going to ask you, actually. If you could zoom in for us,
Sure.
was Friday a true bearish engulfing candle? Because you notice, did we open a little bit higher than Thursday's? I don't know if it's a quote unquote true bearish engulfing. Gosh, we'd have to really get close.
All
But
right.
anyway, I think the point though is you notice we're almost at the high of Thursday, if not a little bit higher. And then we go all the way down on Friday. I think that lends a lot of bearish sentiment for those of you candlestick traders out there. So what are you going to be looking out for? You're probably going to be looking at the volume as the day progresses today. Do we have increasing volume on increasing movement? Or what you got to watch out for in the bear camp is, do we have increasing volume on decreasing movement? If it's the latter, then you're going to be a little bit concerned that we might have a weak start to this week and a potential weak finish to the rest of the week if this bearish engulfing holds true.
If you want to know how close you are, Jeff, the high from Thursday, 21,776.08.
Okay.
The open on Friday, 21,776.28. So 0.2 above the high. That was the open. Now, we traded as high as 21,869 intraday before reversing course and closing dramatically lower, picking up steam as we moved through the low of our high day, technically in the trend, right? So it becomes questionable. It is an engulfing candle. Can lead to bearishness. Hasn't started that way, Jeff. So what about the 5-period, 5-day chart that maybe give us a little further detail on whether what we're looking at today? There's my red line. Okay, so that's the same ledge. Now we gapped the pivot point. That should be an optimistic viewpoint, shouldn't it?
Mm-hmm. You would think so, but again, it's really how things are going to be shaking out. Now, one thing I might start to look at, and it's a little bit too early in the morning, we've only got a few minutes in on the day, but what you may want to add for the viewers out there to your intraday chart is the volume. But as I mentioned before, you're going to want to look at what does everybody think as the volume is changing? As we're going higher, is volume increasing, or do you have a divergence where the volume is decreasing? So that might be what spells out for the rest of the day, what could happen going into the close of Monday, and then also the open of Tuesday, close of Tuesday, and then possibly even into Wednesday. Those bearish engulfings, Kevin, they stay on people's mind for a good few days in my experience.
Yeah, you're right. They can take that amount of time to kind of play out, right? We should also note that if we're working with indices, though, we're not going to get volume in a lot of these cases, everybody. So if you're looking at it from a standpoint of maybe a fund that tracks that indice, perhaps that might be a good way to value volume specifically. Just keep that in mind, everybody. Okay, Jeff, there was also something before we move into small caps. You and I were talking pre-show about the nature of the market, and we felt that we could share some insight when looking at the longer range trend of things. So what I'd like to do is toss it to you to share some details about the S&P 500 and the broader market in terms of our longer term trend and the drawdowns that we typically get, which have been a little different in the last couple of years, hasn't it?
Yeah, you're right. And I got to give a shout out to our friends at the Schwab Center for Financial Research. They're the place that I'm getting this information from. They produce a chart book every quarter. And so this comes from the Q1 chart book. If you want to get a copy of that, go into your local branch and talk to your financial consultant. But Kevin, one of the things that I noticed, because I was thinking about, well, what happens during drawdown time? And gosh, 2023, banner year, up more than 20%. 2024, banner year, up more than 20%. Does that mean we have to revert back to the mean in 2025? So here's what I found out, everybody. In 1995, we had a 3% drawdown that year, but finished the year up 34%. 1996, we had an 8% drawdown, finished up 20%. 97, 11% drawdown, finished up 31%. That's 3 years in a row so far. 98, we were down 19% in 1998 at one point in time, still finished up 27%. And then finally, in 1999, we had a 12% drawdown, finishing up 20%. That is 5 consecutive years in a row where we were north of 20% on our gains, even though we saw some pretty strong double-digit drawdown. So the reason I highlight that to the viewers out there is because it doesn't necessarily mean that if you have a bad month or a bad 2 months and there's a lot of volatility at play that you're going to have a bad year. You can see some pretty strong drawdowns and still have some pretty good returns coming out of that year. So keep an eye on that as you're watching the news and as you're looking at different things playing out in the market. So just like to give a little bit of a historical context there, Kevin.
You know, context is so important, Jeff. It's really easy to get lost in the day-to-day conversation and find ourselves over concerned about what's happening yesterday and today, more so than maybe the longer, broader trend. That's why looking at these longer range charts, these are both 25-year charts on the SPX and the NDX, and you can see that, you know, there are periods of sideways. I mean, Jeff, this was a very lengthy period of sideways movement. This was late 98, and we had peaked at the same level twice through December, basically, of December of 2007, Jeff. So you could see that some of these trends will go even sideways over extended periods before we start to get these lovely moves to the upside. And even strong moves to the upside get pushed back for periods of time. And I think the reminder that we traders need is that what goes up will eventually come down. There will be a drawdown offering opportunity, but even the drawdowns, Jeff, this was a big one here for the market, right? After 21 was such the bottom in 20 to 21's peak. You know, we went through a healthy drawdown. This, I think, was about 30+%. And then it reversed, of course, as is often the case. We found support, bring buyers back in, and now we've got a new longer range trend working. And if you just go back from when that trend was really well established, Jeff, probably the easiest point would be this one here, right? The first real higher low we got out of it. If you just look, this was March of 23 to where we are right now. Let's not even take into account the high. Just to where we are right here, you're looking at an excellent return, about 58%. And Jeff, you know what? It's a great reminder that we can't expect what's gone on in the last 2+ years to continue. If we want to take a casual, more passive approach, we can absolutely believe in the longevity of the trend we've seen, but know where you would decide that that trend is no longer prevailing. For a lot of traders, Jeff, as just a visual on this particular chart, that would shift with a weekly close below that purple line. We haven't seen that yet, at least not since October of 2023. And that would be a shift to the trend, Jeff. And so longer term, you got a lot distance to work with. Shorter term, you could start tightening things up a lot earlier if that's your process. But Jeff, there's a huge difference between traders that watch this market on a day-to-day basis and investors who watch it on a week-to-week, month-to-month basis.
It's such a good call out. I think what you're highlighting here, Kevin, is the importance of knowing your time frame. You got to be careful too, and a lot of traders experience this. And Kevin, I know you've done this. I've done this many, many times, where you get into a trade that you're saying, well, this is only going to be for a few weeks, maybe a month. And then what happens? The trade works against you and you go like, well, I guess now this is an investment. Be very careful about that. As you're looking at your trade plan, as you're setting up the trade, make sure you're focusing on those exit points. If your trade plan says, I sell out when we have 3 closes below the 50-period simple moving average, follow your trade plan. If you're saying, well, you know what, I like to trade just a small portion of my portfolio, but actually the rest of it is invested, I have somebody that manages that for me, great. Don't take what's happening in your trading portfolio and start ascribing that to something that a fund manager or a portfolio manager might be doing for you in the bulk of your net worth. You got to be really, really careful about that. As somebody who works with our folks in the branches, I see that all the time where somebody will say, well, I'm noticing this in my trading account, so I think my portfolio manager should start making adjustments to my investments. Generally not a good decision, and for the reasons you just highlighted, Kevin, because long term, you want to stick with your overall trajectory and goals. Call it 10, 15, 20 years out.
Yeah, I think that's the healthy reminder for us, right? We know those of us that like to trade probably do so with dramatically smaller portions of our portfolio. A lot easier to manage things on the longer haul with a well-defined and cleared plan of attack approach that you know you're going to want for the long window of time for investment. Now, Jeff, we've been kind of mired in the Russell 2000 here beneath that 50-day moving average. I'm going to zoom into the action of the last few months, and you can see that once again, last week got a pretty clear rejection there at around 23.25 and the confluence of the 50-day moving average. Now we've managed to set higher lows in here, but I'm afraid, Jeff, that for the week upcoming here, it's probably going to be tied to inflationary data and movement in the 10-year yield, which we're going to look at here momentarily. What are your thoughts about small caps and what we're seeing here?
Well, one thing you could keep in mind is the January effect, and this was made famous by Yale Hirsch, who started the Trader's Almanac back in, I think, 1973, and he looks at what happens in small caps and says, well, small caps can be a determinant on what goes on throughout the rest of the market. And you notice for January, small caps are doing relatively well. I think we came into the year slightly positive, maybe a little bit on the flat side. So you've got that going on. I'd also highlight, too, for the viewers out there, the January barometer, which says, as goes January, so too might go the rest of the year. Now, this is something that they've studied from 1950 to 2025, and we'll see how it plays out this year. But from 1950 to 2021, they had an accuracy rate of 84.5%, which says, if January is positive, so is the rest of the year. So a couple things you may want to do with this information, Kevin. One, what does the January effect truly mean? Jeffrey gave me a little bit of a tidbit. Now it's time for me to go and do some homework. Let me find out more about this on my own. What does this mean for small caps, and what could it mean for the rest of the year? So those are some things that I'm keeping in mind. I also, Kevin, I noticed, gosh, look at that. You've got your 50 period and your 20 period just coming together nicely. And again, like we're seeing in a lot of things in the market, is it going to be a break up? Yay, let's start cheering, or is it going to be a breakdown? Oh no, is this going to get worse? We got to keep our eyes on that.
Yeah, it's tough to know, isn't it, right here? I mean, obviously, if we got to close below the 20-day, that could be the move that shakes you out. But if you did that last time, you got shaken out on a move that led you right back into resistance first, right? We made another higher low in here. So some would tell you, hey, you could position and work against the low we made on Friday. And maybe you move on only if we trade through the low that we made on Friday. That could be, a continued move to test the ledge here, the 200-day moving average. Ultimately, if you want to be bullish, I think many traders would suggest they're looking for a close over 23.20 to the upside. They'd feel more confident with that. But the fact is, you could suggest right here, Jeff, Russell's sitting on potential support. Now, if we migrate over to the 10-year yield, it's interesting here because look at what's going on now. We had that breakdown in the yield, a quick rally back into the 50-day. The 50-day was support along the way. Now that it's been broken and violated for what is now 4 days, yet today looks like a rejection potentially at the 50-day, doesn't it, Jeff? I mean, we got through it a little bit. Now we're trading at the low of the day, or at least the yield is at the lowest it's been today. And if that bar extends further and we move lower in yield, well, then this could present as a rejection in yield prices at resistance, the same time that the Russell is at a bounce spot for support potentially. So those two things can work hand in hand here positively for the Russell.
Most certainly. Hey, Kevin, question for you. I know the bond market is much, much bigger than the equities market. I'm just curious, in your experience, and this is just throwing it out, I'm not sure if you have any information on this, just wanted your insights. Do you find that institutional investors may be looking more at the bond market to see what's happening there and then do some shifts in the equity market? Or do you think the equity market doesn't work so much in conjunction? I'm just curious on your thoughts, maybe any insights that you have for us and the viewers.
I'm not sure if I've got insights per se. I mean, I think I lean into the idea that what you stated is valid. That is that the bond market by definition is larger than the equity market. Certainly, I think it's safe to say that institutional investors and those with the deepest of pocketbooks often rely on the bond market because they can afford to, right? You have more scalable assets. It's much easier just to take a very flat approach to the investing and just say, I'll take the 4% locked in or nearly implicitly backed by the U.S. government, for example, right? Treasury notes.
Right, yeah.
I'm more than happy to take a 4.5% Treasury yield, feeling very confidently. But that stated, I think that there's a lot of investors out there that pay closer attention to the bond market and use it more as signals for what the equity market could be producing. I have to admit, though, it's not the way that I look at things. It's not something that has ever made sense to my familiarity with the market. But again, I started learning about the market from the equity side and found bonds and fixed income to be just not the thing that caught my intrigue. So it doesn't mean it's invalid. That I will definitely not say. But for my personal aspect, it's going to start with equities more so than bonds, I would say.
Gotcha. Great insight.
Okay, Jeff, we are getting a good move today, and we're going to see how this relates to the price action in the chart. But we're getting a good move in the semis today. One of our groups that just hasn't gone anywhere for the better part of the last 9 months. And of course, inevitably, I've got a ton of drawings in here, but we are right back at that confluence of all the major moving averages. Jeff, if you've seen a chart that maybe defines how we haven't gone anywhere more than this one, with all three major moving averages in 20, 50, and 200-day timeframes right on top of each other.
Kevin, this is a really good call out, my friend. For a lot of us as traders, what we're looking for are certain things to happen. And I know for a bunch of you out there, you're looking at the 20, the 50, and the 200. It's very, very common that these are being looked at. If you notice this chart, this is a messy looking chart. I mean, just look at it. You're going above, you're going below. These lines are crossing, they're not crossing. This, I think, is a great example of saying there are times where you have to just sit back and say, I cannot figure out this trend. I don't know what's going on here. It's all over the place. I just can't seem to get a read on what's happening. And what do? You sit those times out. So I really like this call out here, Kevin, because for some of the viewers, they're saying, I can't figure out what's going on. Are we going up? Are we going down? It's okay to say, I can't get this one. There are other opportunities out there, and you start looking around. So yeah, sure. You're absolutely right. Excuse me. As we're looking at these moving averages, 20, 50, 200, all of them seem to now be the resistance as they are above our current levels. So what might a trader be looking out for in the semis this week? Well, can we get back above this messy chart, this movement of all of these being so close together? Or are we going to break below that one more time? And gosh, I guess this is going to be an exciting period for the semis, but ultimately it could decide whether or not we have more bullish movement in the rest of the market because of that IT focus.
I think you're right on the money there. I mean, 51.15 looks to be the number approximately. The 200-day is at 51.14. The 20-day here today, according to the detail above, 20-day is 51.11. So if you got to 51.15 on a close in the SOX here, then you are above all three major moving averages. And, that doesn't mean necessarily anything, but if you're looking for a way to set risk, some traders would say a close over that gives them the confidence to set a tight level of risk beneath us, where they would move on if maybe you got thrown back below the low today. But the opportunity exists to get back to the peak, or at least to the highs that we've been beaten back from recently at around 53.25, 53.30, and so on. This is a very clear spot of resistance, though, where we have struggled. Even on periods like this, 3 days, even the hoarder rule got to day 4 here, Jeff, over resistance and didn't hold. I think it's just an excellent reminder that all of our rules of thumb, as well-intended as they are, they don't always work. And I think it's an excellent reminder of what we do here in trading. And I say this frequently, trading is not about certainties. Trading is about probabilities, and then positioning ourselves for the probability we think will play out and doing it with proper investment dollars. Dollars we're comfortable devoting to any one position at any given moment, and recognizing that we could get that to work the way we want, but just as likely it could go the other direction. It could go against us pretty easily. So,
I love that. Buddy, this is why I love coming on the show. Trading is not about certainty. It is about probability. I'm writing that down. I'm writing that down. I hope all the viewers are writing that down as well. That is an excellent insight, Kevin. Thank you very much.
Absolutely. I wanted to answer a couple of things in here. Of course, yeah, Mike, we agree. Jeff's got excellent insights, of course.
Thank you.
We only get Jeff once a month, but he always comes with fantastic thoughts and insights for us all. So great. Yeah, the moving averages here, Carol, these are all simple moving averages on my daily chart. So on the daily chart, the weekly chart, I'll rely on simple moving averages. On my 5-minute bar here, when we navigate into the intra period, though, this is a 20-period exponential moving average that can be used by some shorter term traders just as a view of bullish versus bearishness on a short-term basis, intraday more consistently. But reminder about trend analysis, I got to point out as well. Remember, the shorter your time frame, the less reliable your technical analysis detail becomes. The longer the window of time and the broader the trend is, the easier that technical analysis becomes. Sometimes you need to, that's why we say all the time about pulling it back and looking on those weekly charts can be very, very helpful to see the real trend and not get bogged down by all these data points that you get on a daily chart, as an example. There was... Let's see, Jeff, did I have a headline in here? I was looking for something on NVIDIA today that, yeah, here it was. It was both Microsoft and NVIDIA taking quieter approaches to working with President Trump. Both CEOs are meeting with him the past few weeks with little to no fanfare on the discussion. Their footprints in Washington, however, noted as being rather opposite, with Microsoft one of the savviest players on policy issues, and NVIDIA still a bit of a rookie in that area. I thought we could look quickly at the chart of NVIDIA here, which has managed to bounce back quite nicely off an area of potential support there, Jeff. So it looks like that zone at around 116 on NVIDIA became pretty clear support. When you're thinking about this from a technical standpoint and what's occurred here, what are we looking at the 50-day that kind of resides right above us here at this point?
Yeah, you can't deny that. Excuse me. You've got to get your eyes on the 50 period, no doubt about it. Notice too, also for the viewers out there, look as we're coming up. What, 1, 2, 3, 4, 5, 6. 6 green days in a row. Watch your volume down there at the bottom. As we're going higher, coming into that 50, you see how the volume is kind of starting to decrease? Audience is getting a little bit quieter. Maybe we're not so sure about this bull run. So that's how you look at the volume. Is the audience cheering on what's happening, or are they getting a little bit quieter? So as I see the movement into the 50 on decreasing volume, what that may tell me as a market technician is that we could see a pretty decent level of resistance coming into the 50. Ideally, what would all of us like? Well, we'd like the bull market to continue. We want NVIDIA to continue to rally. That can help push the rest of the market. I think there's some good comment out there that there's a lot of folks that have NVIDIA in their portfolio. There's a lot of traders and a lot of investors and a lot of institutions, the trifecta. A whole bunch of groups of people are going to be looking at what happens with NVIDIA. So I think that 50 period is set up nicely, Kevin, just as you called out. That could be where a lot of attention is going to be for the rest of this week.
Yeah, it could be. There's some notes here about filling the gap. We are into the gap zone. That's what that oval delineates now. And I'll tell you what, I guess if you're a trader who thinks that the gap is due to be filled, the question becomes whether you can take on a position right now and get that done. Because if in order for the gap to fill, we have to see it rally into about 140, 175, 142. Here we are at 134 almost. So that's about a 7 to 8 point potential move. And so if the trader felt that could go that way, Jeff, they have no option. I think they need to be defensive to the level that says they shouldn't risk maybe more than $2 to $3 to the downside from a risk reward standpoint. Does that stand to reason in your view?
Yeah, I think that's a really good call out. Risk to reward. I don't think that I get that enough on my desk frequently enough. Risk to reward. What could I make versus what I could lose? Kevin, I love that call out. Really good insight, my friend. Very, very, very smart.
You know, I talk about that one quite a bit. In fact, last week, there's a Thursday class that I'm providing these days called Getting Started with Stock Investing. And last week we did the portion devoted to how much to buy. And in fact, I posted it on X as well. A good conversation for those of you who maybe are in the habit of always buying 100 shares or always buying 25 shares. You know, the key to Consistency in trading, I think, is devoting the same amount of dollars to each trade or having levels that you devote, meaning a full trade is this many dollars. Half of a trade is this many dollars. The point being, giving yourself reasons to devote a certain percentage of your investment capital based on your confidence in the trade, right? And maybe being a little more willing to, when you got all the signals pointing your direction, you go ahead and take your full position versus some of the instances where some of the signals are a little unclear and you still want to participate, you take a smaller position so that you can participate, but if you're wrong, you get hurt less. These are the things, Jeff, that I think we traders initially have to really grow comfortable utilizing, right? It's easy to fall prey to the idea that I'm always investing X dollars or X number of shares, but commonly we should incorporate some semblance of price action and detail to help us make those decisions along the way.
What a great insight. Hey, Kevin, I got a question, and this is actually coming from one of the viewers. I'm actually curious on this answer myself. Is NVIDIA forming a bear flag with that gap down? Talk to us maybe a little bit about could that possibly be a bear flag? I actually don't know, so that's why I'm genuinely curious.
I mean, it sure looks like it could be, right? I mean, if we talk about this being the flagpole, right, from down to here. So let's just draw it straight down to the level. So this could be the full move. Then if we talk about the flag itself rallying like this, it looks pretty steep, admittedly. So this is a steep bear flag situation. The question becomes whether we are at a point where we could be breaking the bear flag and eliminating the risk of the bear flag. And real quickly, what's the risk of the bear flag, everybody? Well, it's that the flag cloth gets rejected and we get a move equal to the flagpole that we got. And so this is a pretty important level because a break under this trend line would be concerning for the bulls. It most likely implies a little bit of a pause. The potential, though, exists, Jeff, that we could break this uptrend line that we've drawn in, this very steep one over the last 6 green flags. And instead of breaking and holding the 200, we break and hold maybe the lows. But if we don't hold the lows, then maybe the measured move calculation comes into play. Now, the last thing, Jeff, that I got to point out is that this is all, this could go that way. It doesn't have to. But one of the other things that some traders will look at is the move it made itself using a Fibonacci draw. If you take from the peak to the bottom, well, look at where we are, Jeff. What is stated as it relates to the Fibonacci's? That if you make a directional move and the move reverses by greater than 61.8%, well, then you now have a chance to go back to where you started the line. Okay, so what are we seeing? Well, the 61.8% level coincides right at the spot that you and I were just calling major resistance anyway. So we have learned that we've re-strengthened 135. Ultimately, the traders are looking here, short-term traders, probably thinking a close over the 50-day, we're going back to 150, potentially, right? That's a 15-point move. A rejection at the 50-day, we have every shot to make a new lower low as well. So that's what I'm seeing here. I don't know how it's going to play, but I think the levels tell us quite a bit with a few different viewpoints here, Jeff. Your thoughts?
Excellent. Buddy, I learned so much every time I come on this show. This is why I'm so grateful to be here with you. And I think a lot of the viewers are in the same position I am, right? Like, look at all these insights that Kevin has for us. I just, in the last 5 minutes, took away 3 things that I had completely either forgotten or never learned. So thank you so much for highlighting that 61% rule. I do not know if I ever remember having learned that. So that is a beautiful insight, my friend. Thank you so much.
Anything we can do that strengthens or maybe validates the level. Now, the caution here, Jeff, as you know, the hard part about this is trying not to allow, not to look at this and say, well, I'm not letting my bias lead me, rather letting the detail lead direction, my decision-making, not my bias one way or the other. And so right here, if you're a buyer, if you were a buyer at 113, well, then the trader needs to be willing to consider that this could be the last move it made, right? This could be it. It's possible. So if that buyer at 113 is staring at it at 134 saying, this could be the end of the move, what am I going to do if it is the end of the move? How will I define that? Should I be taking profit now or where would I look to take that profit, right? Are you a trader who says, I'm going to trade out of my longs in NVIDIA only if we trade below today's low? Maybe today is the high in the day that gives us the low in the high day. Meaning, remember, we often talk about hold, right? If you are a buyer at support, you get a close above the high trade of the low day, then you think that the trend is reestablishing, right? Well, if this is the end of a bullish move to the upside, where are bears going to feel emboldened? With a move or trade below the low of the high day. So if this is the high day, well, then this ledge becomes very important for the bears, right? So bears get a rejection here. Maybe they start to get enthused on a move under 130 to the downside, Jeff. So another consideration.
Always an exciting time. This is what I love about the markets, Kevin. There's never a dull moment, and that is what I find so fascinating about this wonderful experience.
Me as well. Jeff, there was also a headline here on Tesla this morning that I thought we could look at because Tesla's chart has recently broken as well, and I wanted to cover this. More than anything, not so much this all-time 415 level. Let me lift that orange line from here. But I was looking at, Jeff, this flag situation that I thought was favorable until recently, and then just this last 3 days falling through major support. The news on Tesla today was Stiefel lowering the target on price action here to 474 from 492, still maintaining a buy rating. Firm is citing the company's mixed Q4 results and uncertainty that has been caused by the administration and the brand's low favorability ratings for these target cuts. Tesla's key positives include record low Q4 cost of goods sold per unit, a lower priced vehicle that's due out in the first half of the year, and Optimus production. That's their robot, Jeff. I don't know if you've been watching what's going on with that, but that's also an interesting detail. But Jeff, I can't. So I was looking for a good reason. Now I got a good reason to talk about the chart. Jeff, a significant development in the last 3 days, though. This is not a great looking chart all of a sudden on Tesla, is it?
It's just not what you'd like to see if you're in the bull camp. Now, if you're somebody that's in the bear camp, lower lows, lower highs, I think right at about, we'll call it, what is it, maybe 340 or so. That was your previous resistance level hit back in November, tried again in mid-November, and then it eventually broke above it. That may be where traders are starting to look at a potential support line in Tesla below this level. I can't imagine, excuse me, everybody, I can't imagine it doesn't take a break before it goes down to the 200, if that's where it eventually ends up going to. So yeah, right about that level right there. Be very tough to see something just kind of fall out of the bottom because there isn't any news that came out that we don't already know. We had that earnings announcement. People had a chance to digest it a little bit. We're starting to see some weakness. I don't know that that earnings announcement was bad enough that says, okay, let's immediately start racing to the bottom. Could be a little bit of a shakeout. This might be one of those things you keep an eye on. And again, similarly, Kevin, as I talked about before, if your trade plan says, hey, I cannot figure out what's going on with a position like Tesla, fine, just look at it. Don't place any trades. Sit back and say, hey, really good commentary. Neat to look at the experience, but ultimately this is not something that does well in my trading strategy.
Yeah, that's an interesting spot, isn't it, Jeff? I mean, you always look for support at the most, obvious level. There's seemingly support there at 361, these prior highs and what looks like a bit of a bull flag or a rising ascending triangle through here. We broke that. We made an excellent move to the upside. So maybe there was some significance there. We could also, of course, look at the most active levels for prices. Take a peek back to, Jeff, this announcement we had, which came on, this looks like October 23rd. This was after market close. What if we did a Fibonacci from this move? I know I'm going to do it again. I never get bored drawing Fibonacci lines,
Love
Jeff.
the Fibonacci
but I'm wondering if the green line we just drawn in, is that in an area of importance relative to the Fibonacci move? So if we just looked at it from this low to the peak we made, darn it. Okay, well, I guess sometimes that was legitimate. I did not check that one out pre-show. Pretty impressive that it's a 50% pullback level, Jeff. Could that be strengthening this ledge at 345 to 350 as potential support?
It certainly gets a few more eyes on it thanks to the Fibonacci sequences. And as one viewer commented, the golden ratio. Yeah, you love when things just work out live as luck would be in the middle of the experience. So yeah, I think probably now that you've highlighted that level, there's there's probably a few more folks that are going to be keeping their eyes on that 350 spot.
Yeah, I think you might be right. And if I can't help it, but what once was support could now be resistance. We're going to have to color that second line here, the red one, as potential for a bounce to run its course, meaning any bounce that happens could lose steam at, say, 380 to 385. Note the orange sloping 20-day moving average down through the 50-day. So that's not ideal for you short-term traders at this point. It might lead to more defensive nature relative to Tesla in the short run here. But yeah, we often think that we're going to get explosive moves one way or the other, Jeff, and sometimes they're not explosive. Sometimes they're just dribs and drabs. We've moved to a new level. Maybe we spend the next 3 to 5 sessions rallying into resistance before once again a stair step lower. Again, we don't know how it's going to play out, but this much I'm confident in saying, Jeff, rarely does the market work in our time frame. You can know price action pretty well and still be well wrong on time frames for this to occur. It's a good reminder. The market moves in its own time frame. It does not care about you nor me, Jeff.
That's so true. Excellent insight, Kevin. I love that.
Last thing, everybody, I wanted to answer. I saw Valentine's question here in the chat about the volume bars. Volume is one of those details under the gear icon. So if you come in here to the gear, by default, you start on general. Let's slide over to appearance and then scroll down a little bit under this common zone here, Valentine. You're just looking for volume bars. So color as symbol ticks. That means it's going to be identical to what colors you have on over here, right? Your border up, border down, your fill up, fill down, whatever you're using here is what will apply to your volume. Here, you could just say, give me volume in the preset color of my choosing, and that would be static to you. So that's how you would make that adjustment. I imagine you're just right here, have this clicked. You want to click on this instead. All right, Jeff, as always, wonderful insights. As you could see from the many viewers we've got today, lots of great conversational topics from you, and they love your insights, man. Thank you so much for being here and sharing them with us.
Always a pleasure getting to start my week off with you, Kevin. Thank you very much. Thank you very much as well to the viewers. You all have made my day. Pleasure getting to collaborate with all of you. I hope you guys have a great rest of your week too. But thank you so much, Kevin. Appreciate you coming on.
As always, buddy, thank you. And thanks to our viewers. Thanks to Connie Hill in chat. Follow us on X. Hit that thumbs up button down below for us if you don't mind, everybody. We'd appreciate that. Make sure you're subscribed to Schwab YouTube's coaching channel. We look forward to seeing you all again real soon.